The US regulator responsible for commodity markets is considering something that would have sounded almost ridiculous just a few years ago: letting crude oil trade more like crypto. 24 hours a day, 7 days a week, and potentially through perpetual contracts that don't have a traditional expiry date. On the surface, that sounds like a technical change to the oil market, but I think it tells us something much bigger about where the entire financial system is heading. For years, we've asked whether crypto will eventually replace traditional finance, but something quieter has been happening underneath. Traditional finance has started absorbing the parts of crypto that work: continuous markets, programmable assets, tokenized ownership, digital cash, and automated settlement. Once you connect that with what's happening in oil, central banking, artificial intelligence, stablecoins, and tokenized securities, a much bigger picture begins to emerge. The future financial system may not look like crypto defeating Wall Street. It may look like Wall Street gradually starting to operate like crypto. Hi, welcome back to the channel. My name's Paula. This channel is where we look beyond daily headlines to understand how crypto, money, and the wider financial system are really evolving. Today, I want to take one announcement about oil trading and use it to show you how several seemingly unrelated stories are beginning to converge. Because this isn't simply about buying and selling crude oil. It's about what happens when the financial system stops closing. The US Commodity Futures Trading Commission, or the CFTC, has opened a consultation on extending conventional futures markets to 24-hour, 7-day trading. It's also examining whether perpetual style contracts linked to physically delivered energy commodities, including crude oil, could work in regulated markets. The consultation has been extended until the end of August, while the regulator studies the operational and financial implications. Now, it's important to be clear about what has not happened. The United States hasn't approved perpetual oil contracts. It hasn't decided that crude oil will suddenly trade around the clock. Instead, regulators are asking whether these structures can work safely and whether the market infrastructure behind them is ready. And that question alone is significant because perpetual contracts are one of crypto's most recognizable financial innovations. Unlike traditional futures, they don't expire on a fixed date. Instead, they use a funding mechanism designed to keep prices aligned with the underlying market, allowing leveraged markets to operate continuously. Now, regulators are asking whether similar ideas could work for one of the world's most important physical commodities. And this is where it becomes much more than a crypto story. Traditional markets have opening hours for historical reasons. The infrastructure behind them needed time to catch up. Banks reconcile payments. Clearinghouses calculated obligations. Brokers updated positions and moved collateral. Closing the market wasn't simply tradition, it was an operational necessity. But digital markets don't have the same constraints. Bitcoin doesn't know it's a Sunday. A blockchain doesn't stop because it's a bank holiday. Smart contracts don't finish work at 5 o'clock. As finance becomes increasingly digital, those traditional opening hours begin to look less like a necessity and more like a friction. And that change is already spreading. Traditional exchanges are extending trading hours. Settlement systems are becoming faster. Tokenized assets can move beyond conventional market sessions. Stablecoins transfer value at any time of the day. The direction of travel is obvious. The oil consultation matters because oil isn't a digital asset. Crude oil exists in the physical world. It has to be produced, transported, stored, insured, and in some cases, physically delivered. That creates challenges Bitcoin doesn't have. A continuously traded oil market raises immediate questions about collateral, liquidity, margin management, and price discovery when parts of the underlying physical market aren't operating. That's exactly what regulators are now trying to solve. And it introduces one of the most important ideas in this entire story. A 24-hour market requires 24-hour infrastructure. It's not enough for an exchange to remain open. The money has to move, the collateral has to move, settlement has to happen, risk has to be calculated, custody has to update ownership. Every layer of the financial system has to operate at the same speed as the market itself. That's where stablecoins suddenly become much more interesting. Imagine an oil trader facing a large margin call at 2 o'clock on a Sunday morning. Moving conventional bank money across institutions outside banking hours can still be slow and fragmented. A regulated stablecoin or a tokenised bank deposit could potentially move immediately. The same applies to tokenised government bonds being used as collateral. This is why I don't think stablecoins are simply digital dollars for crypto traders. I think they're becoming candidate settlement assets for continually operating capital markets. If tokenised assets trade around the clock, the money paying for those assets must move around the clock as well. And that's why I think banks are investing so heavily in tokenised deposits. They're not trying to become crypto companies. They're trying to ensure commercial bank money remains relevant inside a financial system that never sleeps. Stablecoins, tokenised deposits, and potentially central bank settlement assets aren't necessarily competing to replace each other. They're competing to become the cash layer of the next financial system. And this transition couldn't be happening at a more complicated economic moment. The Federal Reserve is still trying to return inflation to its 2% target, but today's inflation environment isn't being driven by one simple factor. Energy prices remain elevated, tariffs continue to increase the cost of imported goods, and artificial intelligence has introduced an entire new source of demand. That's the part I find particularly fascinating. AI is usually discussed as a productivity story. Long term, it may well reduce costs across the economy, but right now, it's an investment shock. Building AI requires enormous spending on data centres, electricity infrastructure, specialist hardware, and skilled labour. The very technology expected to improve productivity over the coming decade is simultaneously increasing demand for energy, materials, and capital today. Ironically, the AI boom supporting financial markets could also make inflation harder for central banks to control. Now connect that back to oil. Oil feeds directly into transport, manufacturing, and food prices. Add tariffs, add AI-driven infrastructure investment, add weather-related disruptions to agriculture. Suddenly, central banks aren't dealing with one temporary inflation shock. They're managing several that reinforce one another. The Bank of England faces a similar challenge. At its June meeting, the Monetary Policy Committee voted by 7-2 to keep bank rate at 3.75%. Two members actually wanted to increase rates to 4%, not cut them. Its next policy decision arrives at the end of July. That matters directly to people here in the UK. Higher interest rates mean more expensive mortgages, higher borrowing costs for businesses and governments, and less disposable income flowing through the economy. And when liquidity becomes tighter, every risk asset, including crypto, can feel the effects. But there's another consequence that's often overlooked. Continuous markets mean financial markets can respond to events immediately. A missile strike on a Saturday night, an unexpected tariff announcement on a Sunday afternoon, a banking crisis that begins outside US trading hours. Instead of risk building up until Monday morning, prices can adjust instantly. That sounds more efficient, but it doesn't necessarily make markets safer. In quieter trading hours, liquidity can be much thinner. Fewer participants mean even relatively small trades can move prices significantly. These moves can trigger automated liquidations and margin calls, forcing investors to sell completely different assets simply to raise cash. That's how markets become increasingly connected. The asset creating the problem isn't always the asset that gets sold. We've already seen this in crypto. Now the rest of finance may begin to experience similar dynamics. None of this means 24-hour markets are a bad idea. They could improve price discovery, reduce large Monday morning price gaps, and give global participants fairer access across different time zones. But faster markets don't automatically create more resilient markets. They create markets where every layer of infrastructure has to keep pace. And I think that's one of the biggest misconceptions around tokenisation. People often imagine tokenisation simply means putting an asset onto a blockchain. That's actually the easy part. The difficult part is rebuilding the legal, operational, and financial infrastructure that sits behind it. Who owns the asset? How is it settled? What counts as collateral? How is risk managed? How do regulators supervise it? Oil makes those questions impossible to ignore because the underlying asset is physical. You can't solve a failed oil delivery with cleverer software. You can't eliminate geopolitical risk simply by keeping a market open. Technology changes how quickly the financial system responds. It doesn't remove the economic reality underneath. So when people ask whether crypto will replace traditional finance, I think they're asking the wrong question. I think we should be asking, which parts of crypto will traditional finance adopt? Continuous trading may be one. Stablecoins could become the settlement layer. Tokenized deposits may become the banking layer. Tokenized securities could become the asset layer. Blockchain networks may increasingly sit behind clearing and settlement. The technology itself may become almost invisible. Investors will simply expect markets to operate continuously, assets to settle instantly, and money to move whenever they need it. But I think there's one final point that's worth thinking about. Just because markets stay open doesn't mean liquidity will always be there. A market can be open without being deep. A token can be transferable without being easily redeemable. A price can exist even when there aren't enough buyers. The real test of this new financial system won't come during a normal Tuesday afternoon. It'll come at 3 o'clock on a Sunday morning during a genuine crisis, when everyone wants liquidity at exactly the same time. That's when we'll discover whether this new infrastructure has made finance more resilient, or whether it's simply allowed panic to spread more quickly. So yes, the CFTC is officially consulting on whether oil markets could eventually support 24-hour trading and perpetual style contracts. But underneath that announcement sits a much bigger story. For generations, financial markets have been built around the idea that the day eventually ends. That assumption is beginning to disappear. Crypto didn't invent global risk, leverage, or speculation. What it did demonstrate was that markets could operate continuously. Now, Wall Street isn't trying to become crypto. It's just borrowing the architecture that crypto proved could work. And I think that's one of the biggest shifts happening in finance today. The future may not be two separate systems, traditional finance on one side and crypto on the other. Instead, we could end up with one digital financial system where assets, money, and collateral move continuously, and where events in commodities, bonds, currencies, equities, and crypto are transmitted almost instantly across the entire market. Understanding those connections is going to become far more valuable than simply watching the price of a coin. That's exactly what we focus on inside the Crypto Wolfpack. The goal isn't to react emotionally to every headline, it's to understand how the entire system fits together so you can recognise why one story in oil, banking, or regulation can eventually influence crypto too. As always, none of this is financial advice. Continuous markets may create new opportunities, but they can also increase risk, especially when leverage is involved. If you've enjoyed today's video, let me know in the comments whether you think financial markets should remain open 24 hours a day, or whether markets actually benefit from having time to pause. If you found this video useful, please give the video a like and subscribe to the channel, because the next chapter of this story isn't really about markets at all. It's about money. Once markets operate 24 hours a day, they need money that can move 24 hours a day as well. And that's where the next battle begins between stablecoins, tokenized bank deposits, and central bank digital money. Thank you so much for watching, and I'll see you in the next one.